Welcome to another video by the Market Maker SA. I hope you are doing good. I hope yours are trading strong. I hope you are having a good week. Before you continue, don't forget to like, comment, and subscribe. Don't forget to hit that notification bell icon to be indicated in case we drop another video. So yeah, guys, welcome to this new video. Of course, this video is sponsored today. Today was sponsored by FXIFY, a prop firm trading company. FXIFY are one of the best leading prop trading firms out there. And of course, what is a prop firm? Well, a prop firm is a company that gives you funds to trade for people, of course, like us who do not have them large amounts of money to trade. They offer funds for us to use. Now, of course, how it works is you have, once you've purchased the challenges, or when you've purchased a funded account, there's certain amount of rules and regulations that you have to pass before you can get the funded account. Now, of course, the issue with funded accounts is that there's a lot of them out there that are very not trustworthy. But of course, for us, we use FXIFY. They're very, very good, and they're quite affordable. You can see right now the 5K ranges from $59 for 5,000. You can see it's a two-step. As you can see, it's for beginners. It's a two-step for $59, and the targets are quite simple: $500. $500 profit target for the first one. And of course, the daily limit is 4%. So that means for 5K, you basically trying to lose about, you're trying to avoid losing about $200 per day. And yeah, everything is quite good. And as you can see right now, the phase 2 is a bit it's a bit simpler. The profit targets are a bit simple, and the daily loss is still the same. Then you can see the funded account, the daily limit is still the same, and everything is still the same, but however, there's no profit target. That's when you start getting your payouts. So FXIFY, they're very, very good. We use them ourselves. They're very, very reliable, and yeah, they're very, very good. They're very, very professional, and I think you should definitely check them out. If you are interested in buying one, use our link down below. Use our link down below to get a discount. Of course, using our link, and yeah, they definitely check them out. So in today's video, we'll be discussing our ITC model and how we apply our ITC model on a daily in our charts. As you can see, we'll be looking at precisely how we use them to be precise and how we use them to attack the market. And as you can see today, I have my checklist right here. Of course, this checklist being the type of concepts that we use to attack the market on a daily basis. Now, usually how I would usually what's the word am I looking for? How I would usually approach the market when I'm using this ITC model of mine that I've created is that I would usually come into the market. I'll look for an anchor point. I'll usually look for an anchor point or a pre-formation low, and then I would start analyzing from there. So let us begin. Today we're on Bitcoin versus the United States dollar. So let's begin. Now, obviously, number one is liquidity sweep. Now we all know what a liquidity sweep is. The liquidity sweep is a sweep to fetch liquidity down. It's a sweep. It's a move that the market makers make to go collect stops. To go collect stops. It's another word for a stop hunt. But in this instance, it's the move that clears out the liquidity that's been resting at a certain point in the market. Then we all know what's a change of character. Change of character is our break of structure, our market maker shift. This indicates to us that market is about to change direction indefinitely. And then obviously we have our mitigation block. Our mitigation block being a mechanism that indicates the points of interest in the market from a specific area to a specific area. And then obviously we have our internal and our external liquidity highs and our internal and external liquidity lows. These are areas where we expect our liquidity to be resting. Usually it will be on a point on the market where there's a lot of equal highs or a lot of equal lows, that then being our external liquidity high or our external liquidity low. Then obviously we have our point of interest, what we actually gonna use as our main confluence to then further give us a clear decision on where to trade, on where and how to trade, when, how to trade, and which direction we're trading. and if we're gonna trade, of course. Then obviously we have our buy side, sell side liquidity. Usually it's the liquidity that is taken out before market goes into our points of interest, and then we start looking for trades from there. So that is basically the checklist and their definitions. So without further ado, let us begin. So obviously right now on the H4 of the Bitcoin USD, obviously right now we've identified a peak formation low, or not even a peak formation low, it's a bit of a retest anchor formation on the H4. And what we've also identified, right here on the side, we've identified liquidity sweeps right here. I mean, the main one that I see is right here, where market came pretending like it has given us our first leg, then market came back. I mean, there are some people who also traded that, especially with this supply zone right here on the side. They definitely traded that as a buy, and what happened? Market went up, made them a bit happy for around about 12 hours, and then market took them out. Market took them out in one quick move, one quick candle. Market took indefinitely. So that was interesting to see, but that was great for me to see as well and understand it's okay, something's about to happen here, especially with the fact with where we are in the market and how the market context was shaping up. You could tell that okay, with that indication as well of that liquidity sweep, you could tell okay, it's time for market to change direction. Then the market did exactly that. After liquidity sweep, market went back inside, confirming that anchor formation, of course, making of course that a bigger liquidity sweep at the same time, making that a bigger liquidity sweep, of course making that as well a lower low, and obviously after a lower low we expect a lower high. So we expected market to then come back, especially in this huge break of structure. We expected market to give us a very slow lower high back to the top, and we felt like this is something we can capitalize. So that's our liquidity sweep check right there. Now obviously market gave us our anchor formation. Market moved away from our anchor formation, breaking our first significant structure on the H4. You can see right there, breaking that structure, confirming our change of character and our market structure shift. And if you go down to your lower time frames, you can identify even smaller liquidity breaks, even smaller break of structures, but these are not relevant. The biggest one was right there, that confirming our change of character and our market structure shift. Then obviously after here we have to identify our mitigation block. And obviously how do I identify our mitigation block? Is right here. Our mitigation block is from the break of structure to the last supply or demand zone that you marked out. So obviously from this area we have, for me it starts from here, from the break of structure, and it goes down to possibly, I would say, right here where we identified our anchor formation. That then becomes your mitigation block. So from that area to that area, you start looking for your points of interest, or that's an area that will help you mark down your points of interest to reduce your search for your point of interest. So that being our mitigation block. Then obviously external and internal liquidity highs. Well, from this area, after market has given us these equal highs right here, we now start confirming our external liquidity high, where market has given us equal highs right there on top. And in terms of our liquidity low, we would generally look for it round about in this area right here, of course that being the area that was created before the break of structure, the major break of structure, so that being right there. So that was very important there. Obviously we're still on our H4, so that's very important. We're still on our H4. So we've identified our external liquidity high and we've identified our external liquidity low. Obviously that being where market obviously has given us some sort of equal highs and equal lows. So that's very interesting. I mean, it helps you to reduce the range of the range of search in terms of looking for liquidity, in terms of looking for points of interest, for points where market will target before and after the move has happened. It's very important. So you can use these as your take profit targets. Very simple, because obviously an external liquidity high, once it's broken, also becomes your break of structure. So that's very, very important, and that break of structure also then becomes your mitigation block. So that's very, very important. So obviously after here we start looking for our point of interest now, and from the H4, the only point of interest I can see is this huge down candle order block right here, and then see we have a rally base rally coupled with this huge down candle order block right here. Very, very nice stuff. From that area to that area. So that's an area that I was definitely looking at. And obviously for you to further reduce your search, we have this inverted fair value gap right there on the left, but that wasn't really important, as the market really, I mean, at the first, one thing you can identify, a market came to that area, ran away. What happened? The market came back to it, took the people who bought in using that inverted fair value gap, took the people that bought right there out as what? Buy side liquidity. That's our last point. That's our last point right there. Market came back, taking them out as buy side liquidity. So once you've identified the buy side liquidity, and once you've identified your points of interest, it's really smooth sailing from there. You have to wait for market to take out people who went in a bit early, and if you see, and as you can see in this instance, it was these people that traded right here first, who thought that this was the initial buy side liquidity. But obviously high time frame bias is key. High time frame bias is key. And obviously from that area, market moved away smoothly, taking out our external liquidity high, where the resting liquidity was, obviously on the equal highs, and market was gone, taking out that area. And obviously our take profit was going to be there, and market moved, and obviously now use that area to be your new mitigation block. From that area, of course, to your previous demand zone. And you can see right there, beautiful stuff, and market is already moving away from it. That could be a trade that you could potentially take for today. So yeah, guys, that's how we use our ITC model. That's how we use our ITC model for precision. That's how we use it to attack the market and be super precise with it. Don't forget to like, comment, and subscribe. Don't forget to hit that notification bell icon to be notified in case we drop another video. Thank you.